Most beginners lose money in the stock market, not because they're bad at investing, but because they walk in without understanding the rules of the game. They chase hype, react to fear, and try to guess what happens next. And in a market filled with professionals, algorithms, and noise, guessing almost never ends well. Here's the part nobody tells you. You don't need to predict the market to build wealth. The stock market grows over time because real businesses grow. They earn profits, reinvest, innovate, and pay dividends. Once you understand that engine, investing becomes clearer, calmer, and surprisingly simple. So in this video, I'm going to show you how the stock market actually works, what a stock really is, why prices move, and how beginners can start investing without fear or confusion. What a stock really is. Here's the biggest misunderstanding beginners have. They think a stock is a number on a screen, some ticker symbol that randomly moves up and down based on vibes or headlines. But a stock is much more than that. A stock is ownership in a real business. Imagine you and a friend start a cafe. You each put in half the money. Congratulations! You're each 50% owners. You share the profits, the losses, the equipment, everything. Now scale that cafe up into a company with thousands of employees and millions of customers. Instead of 2 owners, the company issues millions of tiny ownership slices called shares. When you buy one, you own a piece of everything that company owns, earns, and becomes. There are 2 main types of stock: common stocks and preferred stocks. Common stocks are what most investors buy. You get voting rights and share in the company's growth. With preferred stock, there's steadier income and less ownership control. For beginners, common stock is the main focus. Here's where the mindset shift happens. Every day, the stock market will shout a new price at you. Your slice of this business is worth this today. Some days the number makes sense. Other days it's way too high or way too low because the market is emotional. But the true value of your ownership doesn't change just because the market is moody. What matters is how much money the business makes, how fast it grows, what assets it owns, and how efficiently it reinvests. This is the foundation of intelligent investing. You're not buying a stock, you're buying a business. How the stock market works. Now that you know what a stock really represents, let's talk about how the market itself works. Think of the stock market as a giant global marketplace. Except instead of buying food or clothes, you're buying slices of businesses. Exchanges like the New York Stock Exchange and NASDAQ are massive electronic systems that match buyers and sellers in real time. Here's what actually happens when you buy a stock. You open your app, you type in the ticker, you place an order, and within seconds, it finds someone selling, and the trade is completed. The price you get is the result of millions of these trades happening every day. When more people want to buy than sell, prices rise. When more want to sell than buy, prices fall. That's supply and demand in action, nothing mystical. This constant activity creates liquidity, which means you can buy or sell your shares almost instantly without waiting for days or affecting the price. Now here's why the market is so hard to beat. Every price reflects the collective judgment of millions of people, analyzing news, earnings, trends, risks, and interest rates, all at the same time. Professional investors with research teams, data systems, and decades of experience compete against each other to find an edge, and even they rarely outperform the market long term. Why? Because prices adjust so quickly that it's nearly impossible to consistently find underpriced stocks before everyone else does. That's why most beginners, and even most experts, lose when they try to pick individual winners or time the market. But the good news is, you don't need to beat the market, you just need to participate in it. Why prices move? Stock prices move for 2 completely different reasons, and knowing the difference is the key to staying sane. Prices don't move the same way over days as they do over decades. So let's look at both. Let's start with the short term. In the short term, stock prices move based on emotions, hype, and speculation. In the short run, the stock market behaves like a voting machine. People vote with their money based on how they feel, not what the business is worth. When investors feel optimistic, prices rise. When fear takes over, prices fall. Headlines, rumors, and hype can cause big swings. This is why stocks can drop even when the business is doing fine, because emotions override logic. Short-term moves are unpredictable and often irrational. Now let's zoom out and look at the long term. In the long term, prices are driven by earnings, dividends, and real business growth. Now, when you zoom out to decades, the market changes behavior. Prices stop reacting mainly to emotion and start reflecting the actual performance of companies. Did earnings grow? Did profits rise? Did dividends get paid? Or did the economy expand? Here's a powerful fact. Over the last century, almost 95% of stock market returns came from earnings growth and dividends, not from short-term speculation. Long-term prices follow business fundamentals like gravity. Here's the lesson. In the short term, prices are affected by noise. In the long term, they're driven by business reality. If you focus on owning good businesses and staying invested, you benefit from the long-term weighing machine, not the short-term voting machine. How to start investing. Now that you understand how the market works, how do you actually start investing? Here's the choice. You could try picking individual stocks, researching companies, analyzing earnings, and timing your buys. But remember, even professionals with research teams rarely beat the market long-term. For most beginners, the simplest and most reliable path is a total market index fund. An index fund owns every company in the market, thousands of businesses across every industry. This instant diversification means one bad stock or failing sector cannot destroy your portfolio. Instead of trying to pick winners, you own them all. Historically, this approach beats about 90% of active investors over time. Here's how to do it right. 1. Keep costs low. Every percentage point in fees is money that doesn't compound. Look for index funds with expense ratios under 0.2%. The best ones today are around 0.03%. 2. Stay invested. Trying to time the market destroys returns. Missing just the best 10 days over 20 years can cut your gains in half. 3. Start simple. Open a brokerage account, choose a total market index fund, and automate monthly contributions. That's it. Here's a pro tip. Before you start investing, make sure you have the basics covered. A small emergency fund so you're not forced to sell during tough times, and no high-interest debt draining your money faster than the market can grow it. Biggest beginner mistakes. Most people don't fail because they picked the wrong stock. They fail because they couldn't control their emotions. Here are some of the common beginner mistakes. Mistake number 1, panic selling. Here's the classic scenario. You buy at $50. It falls to $35. Your stomach flips. You check your app daily. Eventually, you sell. You just turned a temporary drop into a permanent loss. Prices fluctuate. That's normal. But unless the business changed, your ownership did not. Mistake number 2, trying to time the market. People think, I'll wait for a dip, or I'll sell now and buy back lower. But here's reality. No one knows the perfect time to buy or sell, not even professionals. Being out of the market on its best days is far more damaging than being in it during the worst days. Mistake number 3, chasing hype. When a stock starts skyrocketing, everyone wants in. But usually by the time you hear about it, the easy money is gone. Hype creates bubbles. Bubbles burst. Mistake number 4, having no plan. Most beginners invest reactively. They follow headlines, social media, or what a friend said. Successful investors have a plan. How much they invest, how often, what they invest in, how long they'll stay invested, and they stick to it. Mistake number 5, not understanding risk tolerance. If a 30% drop would make you panic and sell, you're holding more risk than you can emotionally handle. Investing is not just numbers, it's psychology. Simple beginner portfolios. Now let's take everything we've learned and turn it into simple portfolios beginners can actually use. The first option is the simplest, a one-fund portfolio. Just a single total market index fund. That's it. It gives you instant diversification, minimal fees, and it's effortless to manage. This is the easiest, cleanest way to invest. The second option adds some stability. A two-fund portfolio with stocks and bonds. Here's a typical split. 60% stocks, 40% bonds. Stocks drive growth. Bonds reduce volatility and act as shock absorbers during crashes. But the exact split can be flexible. Some prefer 50-50 for more stability. Others go 75% stocks, 25% bonds, or 80-20 for more growth. The right balance depends on your timeline and risk tolerance. The third option gives you global exposure, a three-fund portfolio. This includes US stocks, international stocks, and bonds. You're now invested in the entire global economy. So how do you choose between these options? Ask yourself two questions. First, what is your ability to take risk? If you're young with decades ahead, you can handle more stocks. Second, what is your willingness to take risk? If volatility keeps you up at night, add more bonds. Your ideal portfolio is one you can stick with, through booms, crashes, and everything in between. Quick disclaimer. These portfolios are just simple educational examples, not personalized financial advice. The goal is simply to show you how beginners can structure their investing in a clean, easy way. And that's the stock market, explained simply. You now understand what a stock really represents, how the market works, why prices move, and how beginners can actually invest without fear or confusion. Most people fail because they overcomplicate things or let emotions run the show. Don't be most people. If you want to go deeper, check out my video on index funds. It breaks down the simplest, most powerful investing strategy for beginners. And if you found this helpful, hit subscribe so you don't miss the next one. Thanks for watching, and I'll see you in the next video.